macro currency signals.
90 days. That's all it took. Not 9 years, not even 9 months. 90 days for a critical metal to double in price. This wasn't an accident. This wasn't a bubble. This was power, weaponized through supply chains. Let me break this down A 100% gain in 90 days is not a celebration. It is a signal flare. It is the market screaming that something underneath the surface has failed. Healthy markets do not behave this way. Prices can rise, trends can build, cycles can turn, but doubling in 3 months is not growth, it is rupture. It means supply was never as available as people believed. It means inventories were thinner than reported, and it means the system was relying on assumptions that no longer hold. When prices move this fast, they are not discovering value. They are discovering fragility. This kind of move only happens when reality arrives all at once. For years, pricing in critical metals has been artificially calm, held down by long supply chains, opaque contracts, and the quiet confidence that material would always be there when needed. Buyers planned production on spreadsheets, not stockpiles. Governments spoke about security while outsourcing the very inputs that made security possible. So when the price suddenly doubled, it wasn't because demand exploded overnight. Demand was already there. What vanished was certainty, and when certainty disappears, price becomes violent. If this breakdown is resonating, make sure you're subscribed and notifications are on. Being early matters in moments like this. Drop a comment and let me know where you're watching from and what time it is on your side of the world. This is a global conversation, and I'll see you in the next one. A 100% surge in 90 days tells us that the market was mispriced long before the move began. It tells us that risk was ignored, discounted, or deliberately hidden. The metal didn't suddenly become more important. It was always critical. What changed was the illusion of abundance. When supply chains stretch across borders, oceans, and politics, they function smoothly only in times of cooperation. The moment that cooperation fractures, the entire pricing model collapses. What we witnessed was not a rally, it was a correction for years of complacency. This is why calling it a win misses the point entirely. Extreme gains are often mistaken for opportunity, but historically, they are warnings. They mark the transition from stability to instability. They show that price is no longer controlled by fundamentals alone, but by fear, urgency, and survival behavior. Buyers are no longer optimizing cost. They are scrambling for access. Sellers are no longer competing. They are rationing. And once a market enters that phase, it rarely returns to its previous structure. The old price becomes irrelevant because the old world that supported it no longer exists. Most importantly, a move like this exposes how unprepared the system truly is. If prices can double in 90 days, it means there is no buffer, no cushion, no strategic reserve large enough to absorb disruption. Everything is running just in time, lean and optimized for peace. That works until it doesn't. And when it breaks, the repricing is instant and unforgiving. The chart doesn't lie. It documents the moment when confidence snapped. When participants realized that this metal was not just another input, but a single point of failure. So understand this clearly. The price explosion is not the story. It is the symptom. The real story is that the global market woke up to a vulnerability it had ignored for decades. A vulnerability created by concentration, dependency, and political blindness. When a critical metal doubles in 90 days, it is not telling you how much money was made. It is telling you how exposed the world really is. And once that truth is revealed, it cannot be unseen. This price explosion did not begin with demand. It began with a decision, a single, calculated policy move that flipped the market overnight. China did not need to flood the headlines. It did not need dramatic speeches or military action. All it had to do was restrict exports. And the moment that happened, the global supply chain learned a hard lesson. Control matters more than volume. Demand was already baked in. What changed was access. And when access is cut, price has no ceiling. For years, the world operated under a dangerous assumption that China would always sell, that exports would keep flowing because trade always finds a way. Manufacturers built entire industries on that belief. Contracts were signed, factories were scaled, technologies were designed around materials that came quietly and reliably from one dominant source. No one asked what would happen if that source chose leverage over revenue. The ban answered that question in real time. It wasn't gradual, it wasn't theoretical, it was immediate, and the market reacted accordingly. This is why the move was so violent. There was no alternative supply waiting on standby, no surge capacity, no hidden inventory ready to stabilize prices. The moment the ban hit, buyers realized they were competing for the same shrinking pool of material, and competition under scarcity doesn't look like normal bidding, it looks like panic. Prices don't rise step by step, they gap, they overshoot, they break historical ranges because the old reference points no longer apply. The ban didn't tighten supply, it exposed how dependent the world had become. It's critical to understand that this was not an economic decision alone. This was strategic. China understands the difference between commodities and choke points. When you control processing, refining, or export permissions, you don't just participate in the market, you shape it. The ban was a reminder that in the modern world, power is exercised quietly, through paperwork and policy. No tanks, no sanctions headlines, just a signature that instantly rewired global pricing. The metal didn't change, the rules did. And here's the part that stunned markets the most. The ban didn't need to be total. Even partial restrictions were enough to trigger a repricing. That's how thin the margin of safety was. The system was balanced on continuity, not resilience. The moment continuity was questioned, every downstream user had to reassess risk. What if shipments are delayed? What if licenses are denied? What if this isn't temporary? Those questions don't wait for answers. They move markets immediately. Price becomes the fastest form of communication. The ban also shattered the myth that demand drives everything. Demand explains trends, policy explains shocks. This was a supply-side earthquake, not a consumption story. Electric vehicles didn't suddenly double. Data centers didn't appear overnight. What doubled was uncertainty. And uncertainty is always priced aggressively because it cannot be hedged easily. Futures don't solve physical shortages. Paper contracts don't replace material that isn't shipped. When reality diverges from financial models, the physical market wins, and it did so decisively. In the end, the China ban didn't just raise prices. It reset expectations. It reminded the world that access is conditional, not guaranteed, that globalization works only until national interest intervenes, and that critical metals are no longer just inputs. They are levers. The 100% gain in 90 days was the market's way of acknowledging a new truth. This wasn't about demand overheating. It was about control being exercised. And once that precedent is set, every critical material becomes a potential pressure point. What the world discovered in those 90 days was not a shortage of material, but a surplus of exposure. For decades, global industry optimized for efficiency, not resilience. Production was consolidated, processing was centralized, and sourcing was narrowed down to whoever could deliver the cheapest unit at the fastest pace. Over time, that efficiency hardened into dependency, and when the price doubled, it wasn't because the metal suddenly disappeared, it was because everyone realized how few doors it actually came through. This metal was never truly abundant. It was simply accessible until it wasn't. Supply appeared stable because it flowed through a single dominant system that never faltered. But stability built on concentration is an illusion. When one country controls extraction, refining, or export approval, the entire downstream world is exposed to that decision-making. The ban forced companies, governments, and investors to confront a reality they had avoided. Diversification had been talked about for years, but rarely executed, and when the moment arrived, there was nowhere else to turn. Overexposure doesn't show up on balance sheets. It hides inside assumptions. Assumptions that shipments will clear customs, that contracts will be honored, that political relationships will remain neutral. Entire industries ran lean inventories because supply had always arrived just in time. Stockpiling was seen as inefficient. Redundancy was considered waste. But when access was interrupted, efficiency turned into vulnerability. The price didn't just rise, it leapt to reflect the cost of having no backup plan. This is where the market's psychology shifted. Buyers stopped asking, "What's the price?" and started asking, "Can we get it at all?" That transition is critical. Once availability becomes the primary concern, pricing models break. Long-term contracts lose meaning. Forecasts become guesses. Every participant is forced into the spot market, bidding against competitors who are just as exposed. And because supply was concentrated, even small disruptions cascaded into massive price reactions. The system was never built to absorb shocks. It was built to assume they wouldn't happen. Governments were no better prepared than corporations. Strategic stockpiles were minimal or outdated. Domestic alternatives were underdeveloped or uneconomical under normal pricing. Years of relying on global trade had hollowed out local capacity. The ban revealed that industrial sovereignty had been traded for short-term cost savings. And once that trade-off was exposed, markets priced in the long road back to independence. New mines don't appear overnight. New refineries don't turn on in months. The price doubled because the timeline to fix the problem stretches into years. What truly shocked the market was how quickly confidence evaporated. The belief that supply chains were diversified enough collapsed almost instantly. Analysts who once pointed to multiple producers realized those producers all fed into the same processing hubs. Different names, same bottleneck. The realization spread fast, and with it came a repricing of risk across entire sectors. This wasn't just about one metal anymore. It was about how many others shared the same structural weakness. The price move became a proxy for a much larger fear. In the end, the world didn't lose access to a metal. It lost the comfort of assumption. The idea that globalization had solved scarcity was exposed as fragile. Concentration had delivered low prices, but at the cost of control. And when control was exercised elsewhere, the market responded with the only tool it had left: price. The doubling in 90 days was the market admitting it had underestimated how overexposed it truly was. What happened next was not a market reaction. It was a strategic revelation. The moment supply was restricted, it became clear that this metal was no longer just an industrial input. It was leverage. In a world where technology, defense, and energy systems depend on specific materials, control over those materials becomes power. And power, when exercised deliberately, turns commodities into weapons. Not weapons of destruction, but weapons of pressure. Quiet, effective, and deniable. Modern conflict rarely announces itself with sirens. It moves through supply chains. It hides in export licenses, regulatory approvals, and shipping delays. This is where strategic metals live. They sit upstream of everything that matters. Advanced manufacturing, military hardware, energy grids, communications infrastructure. When access to those metals is disrupted, the impact ripples outward, slowing production, raising costs, and forcing governments into reactive positions. No missiles launched, no borders crossed. Yet the damage is real and immediate. This is why the price response was so severe. Markets understood something fundamental had changed. This wasn't about profit maximization, it was about influence. By restricting exports, China demonstrated that control over key materials can shape outcomes far beyond the mining sector. Entire industries suddenly found themselves exposed, not to competition, but to policy. And policy risk is the hardest risk to hedge. You can't diversify away from a gatekeeper. You can't substitute a metal that doesn't exist elsewhere at scale. Once a metal crosses this line, from commodity to strategic asset, it behaves differently. Its price no longer reflects just supply and demand. It reflects geopolitical tension, national security priorities, and long-term rivalry. Every buyer must now factor in the possibility of further restrictions, retaliation, or escalation. Every seller must consider whether revenue today is worth leverage tomorrow. The market begins to price not what is happening, but what could happen. That shift alone is enough to justify extreme volatility. The weaponization of supply chains also changes behavior downstream. Companies begin hoarding instead of optimizing. Governments intervene instead of observing. Stockpiles replace spreadsheets. This defensive posture tightens supply even further, amplifying the original shock. What started as a policy decision becomes a self-reinforcing cycle. Scarcity breeds fear. Fear breeds stockpiling. Stockpiling accelerates scarcity, and price becomes the scoreboard of strategic anxiety. What makes this form of warfare so effective is its subtlety. There are no treaties to violate, no laws to break. Export controls are legal. National interest is defensible, and yet the consequences are profound. Industries stall. Costs explode. Political pressure mounts in countries suddenly facing shortages, all without a single shot fired. This is 21st century power projection. Silent, technical, and devastatingly efficient. And perhaps most importantly, once this tactic is used, it cannot be unused. The precedent is set. Every nation now understands that critical metals are potential pressure points, that dependency equals vulnerability, that control equals influence. The doubling of the price in 90 days was the market acknowledging this new reality. It wasn't just reacting to less supply, it was reacting to the realization that the rules of engagement had changed. Strategic metals are no longer neutral. They are instruments, and the world has just begun to price that in. The most dangerous mistake anyone can make is to assume that a 100% move marks the end of the story. In reality, it usually marks the beginning. Extreme price surges do not resolve shortages. They expose them. They rip the curtain back and show how little slack exists in the system. When a critical metal doubles in 90 days, it is not because balance has been restored. It is because imbalance has finally been acknowledged. And once that happens, the adjustment process is only just getting started. High prices are often mistaken for a solution, but in supply-constrained markets, they are simply a signal. They tell producers that something is wrong, but they do not fix it. New supply cannot appear on command. Mines take years to permit, finance, and build. Processing facilities require specialized equipment, skilled labor, and environmental approvals. Even restarting dormant operations is slow and uncertain. So while price can move in weeks, supply moves in years. That mismatch is why the first violent move is rarely the last. What the 100% gain really did was pull future scarcity into the present. It forced buyers to compete today for material they assumed would be available tomorrow. That forward-pulling effect accelerates depletion. Companies increase orders. Governments begin stockpiling. Intermediaries hold inventory longer. Every actor acts defensively, and in doing so, tightens the market further. The price surge doesn't cool demand. It reshapes it into urgency. And urgency has a way of feeding on itself. This is where volatility becomes structural. Once confidence is broken, markets don't simply drift back to calm. They oscillate. Every rumor of policy change, every shipping delay, every geopolitical headline becomes fuel. Prices swing not because fundamentals are changing day to day, but because perception is. The market is trying to discover a new equilibrium without reliable reference points. The old range is gone. The new range hasn't been established. And in that gap, price overshoots repeatedly. There is also a false comfort in believing that substitution will save the day. In theory, higher prices encourage innovation and alternatives. In practice, critical metals are critical for a reason. They have specific properties that cannot be easily replaced without performance losses, redesigns, or regulatory hurdles. Re-engineering products takes time. Certifying new materials takes time. And in sectors like defense or energy infrastructure, time is not a luxury, so demand remains stubbornly inelastic even as prices rise. Meanwhile, supply responses tend to disappoint. Projects announced during price spikes often arrive late and over budget, if they arrive at all. Environmental opposition, financing constraints, and technical challenges thin the pipeline. Some supply that looks viable on paper never reaches production. The market knows this. That's why it doesn't fully trust price signals alone. Instead, it prices in delay, friction, and failure. The result is a premium that persists long after the initial shock. So the first 100% move should be seen for what it is, the opening act. It marks the transition from ignorance to awareness, from complacency to concern, from a market that assumed continuity to one that must now plan for disruption. The price didn't double because the problem was solved. It doubled because the problem was revealed. And until the underlying structural issues are addressed, diversification, domestic capacity, strategic reserves, the market will continue to search for answers through price. The story is far from over. The final realization to emerge from this move is the most important one. Price is no longer the main variable. Control is. Markets obsess over charts, percentages, and returns, but those are surface-level signals. Underneath them lies the real contest: who decides where material flows, who grants permission, and who can say no. In a world of concentrated supply chains, that authority matters more than any short-term price swing. The doubling in 90 days was simply the market acknowledging where power actually resides. When access becomes conditional, price loses its traditional role as the great equalizer. Normally, higher prices attract more supply and balance returns. But when supply is gated by policy, regulation, or national interest, money alone cannot open the door. Buyers can bid higher and higher and still be shut out. That's when markets stop behaving like markets and start behaving like strategic arenas. Contracts become political, shipments become diplomatic, and the ability to secure material becomes a competitive advantage independent of cost. This shift forces a redefinition of what the trade really is. The opportunity is no longer just in riding price momentum. It's in understanding bottlenecks before they become headlines. It's in knowing which materials are processed in only a handful of facilities, which countries dominate refining, and which export approvals can be revoked overnight. Those who focus only on charts arrive late. Those who study control points arrive early. The price move is the aftermath, not the signal. For governments, this realization triggers a scramble for sovereignty. Domestic production is suddenly reframed as national security, not industrial policy. Stockpiles are justified, subsidies are unleashed, alliances are reshaped around material access rather than ideology. None of this happens quietly, and none of it happens cheaply. Markets price these shifts in advance because they understand that reconfiguring supply chains is slow, expensive, and politically contested. Control does not change hands easily. For companies, the implications are just as stark. Procurement is no longer a back-office function, it is strategic. Firms that once optimized for lowest cost now prioritize guaranteed supply. Long-term offtake agreements, vertical integration, and direct investment in upstream assets become survival strategies. Margins may shrink, but continuity becomes priceless. The companies that adapt early absorb the shock. The ones that don't are forced to pay whatever the market demands or shut down. This is why chasing the 100% gain misses the deeper lesson. By the time price has doubled, the control dynamics are already in place. The leverage has already shifted. The real winners are not those reacting to the move, but those who anticipated the imbalance. They positioned themselves around access, not speculation. They understood that in the next phase of globalization, efficiency takes a backseat to security. Ultimately, the market is sending a clear message. Critical metals are no longer neutral inputs traded freely in open markets. They are strategic assets governed by national interest and geopolitical rivalry. The doubling in 90 days was not a fluke. It was a revelation. It told us that the real currency in this system is not dollars, but control. And in the years ahead, those who grasp that distinction will navigate the turbulence. Those who don't will be left reacting to price long after the decisions that mattered were already made. 100% gain in 90 days didn't come from speculation. It came from a ban. And bans don't signal the end of a move. They signal the beginning of a new era. An era where critical metals are no longer commodities. They are currency.